Welcome to SmithWeekly Discussions, an occasional program for our readers and listeners of SmithWeekly Research. Please note this program is a private discussion and everything contained herein is for the entertainment and educational purposes only. We hope you are in a comfortable position, along with your favorite beverage, to enjoy the discussion. So today we have David Smith on the line. David is the portfolio manager of Greentech Capital Advisors Investment Management, an organization that has an investment focus on low carbon energy, green technologies, and related business investments. The company is based in New York and has offices in San Francisco, Zurich, and Tokyo. David, thanks for joining us.
My pleasure. Thanks for having me.
Yeah, give us your background and how did you end up at Greentech?
So my background is I'm a chartered accountant by training. I grew up in Toronto and worked for Deloitte & Touche, covering primarily capital goods, industrial type equipment companies, more on the tax audit and accounting side, and migrated from there into work for a company called Newcourt Credit Group, really talking around financing for capital goods. Shifted gears in 1997, my apologies, moved to Citigroup in New York City, and really focusing around industrials, machinery, engineering, construction type companies, working for a senior analyst and learning the ropes of the investment industry. In 1998-99, I was given an opportunity to really form a new group at Citi focused around what I would call alternative energy. At the time, there were a lot of emerging opportunities, really probably more banking related at the time, a lot of earlier stage companies targeting a new area that was popping up around areas like solar, wind, and some more emerging technologies like flywheels, microturbines, and fuel cells. So with this need for financing, there was a lot of interest at Citi at the time on serving customers around IPOs and alternative forms of financing. So we initiated coverage in 98-99. I was a senior analyst covering what was then alternative energy. A lot of this rode into the tech bubble. You had fuel cell companies like Ballard Power or Fuel Cell Energy that offered a lot of promise for the future, but really had no what I would call commercial or recurring revenues. So the market caps of these companies rode the tech boom up to valuations north of $5 billion, with at the time very little commercial revenues. So what it created for me was a great opportunity to see a lot of momentum in the market and a lot of the hype that accompanied some of what we even see today in areas like blockchain, Bitcoin, and areas like the marijuana stocks, primarily based in Canada. But having seen a lot of this tech bubble and a lot of it deflating in late 2001, it provided a high degree of skepticism as to what really works and what's really economically viable in energy. And I think just the quick takeaway you can say is levelized cost of energy. So at the end of the day, something has to be economically viable in order to be successful, whether it's sustainable, green, or not. The economics have to make sense at the end of the day. I like to call it green has to be green in the case of sustainability. So with the tech bubble bursting in 2001, a lot of my focus shifted more to what I would call more clean tech focus. So less emerging alternative energy technologies and more clean tech opportunities. So when I look at areas like solar and wind, can they be economically viable to make a dent in the global power stage, and do they make sense as far as the environment goes? Do they make sense as far as the economics goes for long-term success? And at the time, I would tell you it was challenging. Areas like solar, for instance. solar was $12 per watt for a solar cell, which is astronomical when you consider today the price of a solar cell is about 21 cents, the current price. So there's the value of technology and what can happen over a long period of time. Certainly, when we look at things like the semiconductor cycle and the ability of cost to come out of something in the long run. So similarly, when I look at areas like wind power, we've seen massive cost reductions there, and now it's an economically viable technology. So my focus at Citigroup kind of morphed into what I would call, renewables, more sustainable energy generation technologies, areas like smart metering, areas like water, disinfection, treatment, et cetera. And really, at the end of the day, a lot of this is targeting around efficiency, be it any type of resources and using resources more effectively. I left Citi at the end of 2006, went to a long-short fund called Longbow Capital, and really at the Longbow targeted more on the renewables, the industrial side, and the energy infrastructure. Worked at Longbow for just over 3 years. Thereafter, went to a firm called Gabelli. Worked for a gentleman named Mario Gabelli, running the Gabelli Green Fund, and developed a long-only product there as well, called the Roads, Bridges, and Infrastructure, or RBI Fund. Left Gabelli in the beginning of 2014 to go to Greentech, where I am today. And at Greentech, I was given the opportunity to come in as a partner, chief investment officer, and the portfolio manager of the Sustainable Growth Fund. And the Sustainable Growth Fund is really focused around what I would broadly term as energy, food, and water. We're a sustainability-focused fund, really targeting impact companies that can provide an impact in the products and services that they offer to their end customers. And keeping in mind as well, the types of companies that we want to invest in are companies that can make a positive environmental impact, not only from their own operations, but also, the products and services that they sell. So that's a synopsis, maybe a little longer than you were hoping for, but maybe that covers it.
Right. No, I appreciate the information on that. So, what's do you guys Greentech is part of a overall larger group, if I recall. Can you tell us about that, and how do you guys look at, do you guys take, accredited investors? Tell us how it's kind of set up.
Yeah, so the firm actually was started in 2009 by an individual named Jeff McDermott, and first employee, his partner from day one, was Robert Schultz. And the two of them initially started the business as an investment banking or advisory service company. Jeff's background was the head of investment bank, co-head of investment bank, I should say, at UBS. And essentially, the firm was founded to provide financial services, advisory services, primarily targeting around M&A to companies that offer sustainable products and services. Today, we are split between the advisory business and the asset management business. So on the asset management business, which I've broadly spoken about, the Sustainable Growth Fund, we also have a second product called the Emerging Markets Sustainable Growth Fund, and it's really focused on countries other than North America, Europe, and Japan. So really targeting emerging markets, areas like Africa, Egypt, China, etc.
Okay. And what's the assets under management there at Greentech?
It's just under $100 million today.
Okay. And so when you guys look at these different investments, what's kind of the target? Obviously, I think for investors, you guys are looking at the best returns for the investors. So how do you guys kind of weigh looking at the return side and the best value for your investors in the fund versus looking at some of these companies that are starting out that may or may not be very, cash flow positive, or in a sector that's developing that hasn't really become robust.
Well, I think that comes back to some of what I talked about in my history at Citigroup. So I think when you look at these companies, you have to really take a lens to say, what's commercially viable here and what's not. And coming back to my initial comment, green has to be green. And by that I mean that technology has to be economically viable. We can look at something today that's perhaps not commercially viable, like, for instance, cold fusion, which offers a lot of opportunities in terms of low-cost energy, not harmful to the environment, not a lot of pollutants involved, et cetera. We can look at something like that and say, how do we balance that versus the cost or the technological feasibility? Sure, it would be a great opportunity, but in the long run, is it viable today? And there's a lot of risks in that path to getting commercially viable today. When I look at something like solar, for instance, though, really it comes down to technology that actually worked back in 98, 99. I used to look at a company called Astropower, for instance, and they had a roughly 10% efficient cell. So it was economically viable, but the cost actually was astronomical. It was $12 a watt, as I mentioned. If I look at today, you've got solar cells pushing northward of 20% efficient and a cost of roughly just over 20 cents a watt for a solar cell. So yeah, I think that it's an interesting balance that you put out. We look at our fund from the perspective of companies that are existing old world companies that have to adapt in order to remain economically viable in this day and age of sustainability. So if I look at a lot of the upstarts, a lot of the emerging companies, a company like a Tesla, for instance, burns a lot of cash, but they have an economically viable product. There's a lot of execution risk involved in the process. A company like a Bloom Energy, for instance, though, one of the challenges is really the cost of their fuel cell. And similar to companies like Ballard Power, Plug Power, and Fuel Cell Energy. The thing about fuel cells has always been really the cost. It's not whether or not it really works. So there's a lot of risks involved in the path to getting to commercial viability. I come back to solar fairly frequently because it has jumped the curve to commercial viability. So when you look at utility scale solar today, we're looking at prices that are actually more competitive than incumbents like coal, nuclear, and natural gas. So, it's really, when I look at something like solar, it's not really solar competing against solar. The companies don't sit there and actively. Certainly, they bid on specific contracts, but nobody ever sits there and says, "What kind of solar panel do you have on your roof?" It's really an anonymous product. It's ultimately, it's driven by returns. And if I can generate electricity for 4 cents a kilowatt hour, that is certainly going to win market share from the grid. So what solar really competes with is the incumbent solar, the incumbent, which is the grid. So, the challenge with solar, though, really is that it's a race to the bottom, because you never see, in my whole career really of looking at solar, you never see the price or the cost of solar panels going up. It's always been a race to get to a lower cost per kilowatt hour, because you can't really make inroads into competing with the solar or the grid unless the price of solar comes down. The other side of what you mentioned, just to round out this part of the discussion, is finding companies that are economically viable today. And, there's a lot of incumbent companies that make products in the market today that are faced with challenges of more sustainable technologies. And one area that I can point to, for instance, is LED lighting. LED lighting really kind of came on the scene in 2006. And in the United States, as far as Congress went, it was sponsored by a gentleman named Fred Upton from the Republican Party, and there was talk at the time really of mandating the use of LED technology because it used 70 to 80% less electricity than the incumbent, which in this case was an incandescent light. And when you look at the price of LEDs when they came out, it was roughly $35 a bulb. Today, I can go buy an LED bulb at Home Depot for roughly $1 a bulb, and what we're seeing is incandescents are falling by the wayside. They're when I look at companies, old world companies, which traditionally were built on more fluorescent or incandescent type lighting technologies like an Acuity or a Philips, they've now shifted over roughly 70% of their product line to LEDs. So, in this case, what I would say is it's either evolve or die. So, the outcome really is you have to evolve to actually remain economically viable. Because, the way I always kind of characterize these things or try to characterize these is this disruption that's provided by a solar panel, a wind turbine, or an LED bulb ultimately is a better way to do things. I tend to term it as creative destruction. It's basically a better way of doing things. And in the end, if the economics work, then yeah, it's probably going to be economically viable and will take market share. And if the incumbent old world companies don't evolve, then they become irrelevant. The last example I can point to, which has probably been more in the news lately, is the evolution of the electric vehicle. I personally am of the belief that if Elon Musk didn't come along, we would not be seeing the evolution of the electric vehicle as fast as it's happened. And I think he's pushed the industry a decade ahead of when it probably would have started to evolve. And one of the biggest things about Tesla that's occurred is that they've taken a lot of market share. The number one four-door luxury vehicle in the United States, as well as several markets in Europe, is the Tesla Model S. And if you look at the incumbents in that category, it's Mercedes, it's BMW, it's Audi, Porsche, and these are the companies that are losing market share to Tesla. Now it's incumbent upon them to come up with their own electric vehicles to recapture that market share and become valid players in the market, or to die off. And I think the reaction you've seen, Mercedes is coming out with the EQC, Audi's coming out with the e-tron, Porsche's coming out with the Taycan, BMW's got several vehicles coming out. So, really what we're seeing is the evolution of the auto company in order to survive long term. So there's opportunities to invest both in new disruptive companies as well as incumbent companies, in my mind.
Right. So going back, there's a lot of issues you covered there, a lot of different topics. Going back on solar panels, how do you see solar panels competing with their efficiencies at high temperatures in the sun, storage of the power, the footprint of manufacturing solar panels, and then their usable life, and how you take care of them after their usable life is up? What are your thoughts on those?
Well, it varies by technology. So you've actually talked about a few different variables that have been addressed by the companies as this has evolved over the past 10, 15 years. So heat has been a pertinent issue that came up, and how solar panels perform under certain or different conditions, extreme heat or extreme cold. There has been, there's two different primary technologies. One is a silicon-based solar cell, and the other is thin film technologies. Thin film has been widely viewed as having significantly larger market opportunities over a period of time, given the cost characteristics. It's been more of a technology hurdle that has barred thin film technologies from working. There's been one company in particular that's been extremely successful in thin film, and it's a cadmium telluride thin film module. It's for solar, and First Solar's panels actually perform better than silicon in extreme heat scenarios and extreme cool scenarios. And as a result, they've done very well in terms of market share. Their cost in relation to the efficiency has been a bit more of a challenging argument. But we've seen the efficiency of their cells rise as they've evolved the technologies significantly over the past 5 years. They're coming out with a new module. It's called the Series 6 module, kind of at the end of this year and into 2019, that is anticipated to solve a lot of the cost versus efficiency issues related to the technology. On the other hand, on the polysilicon side, as I mentioned, it doesn't tend to perform as well in extreme heat scenarios, but it actually polysilicon has always yielded a higher efficiency than thin film technologies. A polysilicon panel has been typically in the range of 17 to 20% efficiency, 21% perhaps, whereas a monosilicon technology has been north of 22%, with a theoretical maximum, as I recall, around 25%. So, and on top of that, it's on a cost per efficiency basis, it's been a little bit more attractive than the thin film technology. So, there's advantages to both. It really comes down to, at the end of the day, performance and cost per kilowatt hour of electricity. But I think one of the things that we have to really look at in terms of solar technology is, let's get beyond the panel cost. Let's get beyond the inverter cost and the system cost. Let's get to the point where we're talking about levelized cost of energy. And if you look at the levelized cost of energy, what that really evaluates is the cost of an electron.
Right. Absolutely. So how long do these, with the new technology in the solar panel, how long do these things, what's their usable life these days?
Well, there's degradation of the panels, but most of the companies actually guarantee the performance up to 80% over 20 plus years. So, we're seeing projects and PPAs signed, power purchase agreements signed, that extend 20, 25 years on installations. And so, the companies have guaranteed this. They stand by it. Clearly, we don't have a lot of history. But, if I go back to those companies that I mentioned at the start, like a company like an AstroPower, the technology, solar technology has been around for a significant amount of time. But going back, back to my Citigroup days, as an example, I used to talk to a broker who was based in Molokai, Hawaii, and he had a system that he installed in 1972 and was still generating the proclaimed output for the system. The only thing that had to be replaced, and I believe it was more than once, was the inverter, which is really electronics. And the problem is that moisture got in, and it had to be replaced. Which everybody, when we factor in these installations, and when you factor in large projects, you always factor in a replacement for the inverter at 10 to 15 years. So, what I would say to you is that the technology does seem to hold up.
Okay, and what's your thoughts on the storage side? Obviously we know that the solar doesn't work too well when it's dark outside, so you have the storage side. And how does that coincide with coming up with a storage solution that would make solar compete on a base load power basis?
Yeah, that's a very interesting conundrum, and it's something that's evolved again pretty significantly over the past 5 years. One of the facilitators for the market for storage has really been the evolution of the automobile, and certainly the uprising of Tesla. And Tesla's, on its own, leveraged this into the power grid as well, with installations for backup power and ride-through electricity in areas like Australia, you've probably heard about. But that said, the equation changes significantly when you start adding storage into the mix. And we talk to residential deployments, we talk to commercial and utility scale deployments, but at the end of the day, what you're doing is storing electricity at certain varying load levels for a period of time. And obviously, the more batteries you put in, the longer you can store that energy. But our view is that it's a game changer, and that the cost, again, we're always talking cost here, but the cost has come down so significantly in terms of battery storage. When I first started looking at batteries, it was upwards of $1,000 a kilowatt hour. Now we're down talking $100.
Right.
It doesn't matter if it's automotive, it doesn't matter if it's grid storage, but our view is that in the long run, this is what changes the game as far as the grid goes and having baseload power, because realistically, you have to use that power as it's generated today, and if you can store it, it comes down to the economic viability, which we think has improved significantly over the past 5 years, and will improve more.
Okay. Yeah, absolutely. So let's move on just a little bit. We'll come back to Tesla in a moment. So just kind of hammering down through some other sources. So what's your thoughts? On this one here. So what energy forms over the next decade do you see dominating both in the U.S. and globally?
Well, again, it comes down to what our view on the economic situation is, because, I think one of the things is, you can say that you like solar, or you can say that you like coal, or you like nuclear. But, I think one of the rational decisions that's being made out there is ultimately driving down to the electron. And, there's definitely lobbying, political type interests that seem to sway in favor of one technology or the other. But I think what you have to look at the end of the day is what the companies do. So how do the companies react? Companies are always going to react in their own best interest in terms of generating a return and a return for shareholders. And when I look at the cost of technologies, if I look at conventional technologies, I can look at gas combined cycle, coal, nuclear, et cetera. What is the cost of generating electricity? And if I look at there's an annual study that's put out by Lazard that kind of talks about the levelized cost of energy amongst various technologies. But if I look at the price or the cost of generating electricity, the one thing about a lot of conventional power is really the marginal cost, right? I have to pay for the turbine, I have to pay for the facilities, et cetera, associated with gas, coal, and nuclear. But if I look at the marginal cost, it's obviously highly dependent and highly variable based upon the price of natural gas, the price of uranium, the price of coal. The one thing when I look at renewables is that ultimately the feedstock, in this case, solar rays or wind, is free, and ultimately you're paying for the cost of the system is paid for up front. Really, the biggest variable factor is wind speed, which we hear a lot quarter to quarter by region, or solar insolation levels. So ultimately, you're looking to maximize uptime or availability as well as capacity factors across the technologies.
Right. So let me ask you this on another one. And of course, cost versus price is interesting depending on what country you live in, what state you live in, and how many extra fees and taxes are tacked onto your power bill. But do you see, moving on to these other sources, David, do you see hydropower as a growing source of energy in the U.S. or has it had its day?
My view is that it's regional, and it's gonna fit the power profile of certain regions. If I look at the Canada Hudson's Bay corridor, if I look at the Pacific Northwest in the U.S., and then certainly smaller kind of localized projects, it does make sense. When I look at the price of generating or electricity from hydro, it's certainly very attractive. And if I look at, it's interesting. I was listening to a podcast this weekend on mining Bitcoin, but one of the reasons why this firm set up in British Columbia, specifically in old logging town, was that the cost of electricity supplied by Boralex was roughly 4 cents a kilowatt hour. So, when you look at these highly cost-sensitive industries that are looking that use a lot of electricity, I think hydro makes a lot of sense, and it's specific to certain regions, just like something like geothermal is, for instance. Geothermal
Right.
has been very successful in the Southwest, for instance, but you ultimately, what you need at the end of the day is a reliable geothermal deposit. Parts of South America are similar. Hawaii's got some opportunity, but you need that geothermal geographic situation, geothermal situation, to make the economics work. Because ultimately, at the end of the day, electricity is about reliability and uptime.
Sure, absolutely. So what's your take on natural gas power?
Well, the one thing about natural gas from a CO2 emissions perspective is that it's the lowest. When it's burnt, the emissions are the lowest of the conventional power sources, comparing specifically to coal. I'm actually favorable for natural gas as far as a baseload power scenario goes, because I'm actually quite aware that today that solar and wind can't provide reliable baseload power until energy storage comes into play on a large scale. In the meantime, I do think that natural gas provides the most economical and environmentally friendly baseload power scenario, and will continue to do so for several years, many years, in fact. I would say you can't rule it out for a long period of time. And on top of that, it's got a low marginal cost. The price of natural gas is hovered anywhere from $2 to $4 per MMBTU for a long period of time. And given the abundant supply of natural gas, I think it's a very viable technology for the long run.
Okay, and how do you feel with some of the folks in the States? There's some of the folks that are not happy with the fracking and so forth. The kind of let's just put it this way, with the mining end of these inputs that go into these technologies sources.
Yeah, I don't want to be saying that that making a case for the environmental safety of fracking. I do actually concur that there are definitely safety and environmental issues that go along with fracking. But I think part of it had to do with the Wild West scenario, that this was a new market, new opportunity, and everybody was rushing in to try and stake their claim early on. I think now what we've got is a more organized scenario that is developed whereby regulations are coming into place. And I think that regulations are absolutely essential. You've probably heard about some of the issues in Pennsylvania as far as fracking goes, certainly down in Texas and Oklahoma. Earthquakes are certainly something that's come up as well. The question becomes, what is the root cause of some of these problems? Now, when you start or contaminating the water supply for thousands of people, clearly this is an issue that has to be dealt with. So there's a lot of controversies. So one of the things that we've found is there's some companies out there that are making more environmentally friendly fracking fluids, for instance. One of the biggest problems with fracking fluids is basically it's diesel fuel. It's benzene being pumped into the ground. It's getting into the water table. It's releasing radioactive components, and the question ultimately becomes, what if it contaminates the water system? And that's part of the issue in Pennsylvania, for instance, that's occurred. And so, can you come up with a green fracking solution? We have found companies that do provide a green solution to this issue. Earthquakes are obviously another issue that I mentioned. A lot of this has been speculated around water reinjection that's happened and shooting used well water down into storage wells, underground caverns, and disrupting the, the geophysics of the landscape. Then there's obviously areas such as more local issues, such as trucks and road damage, et cetera, and who foots the bill for all this. So, as I said, it's been more early stage. I truly believe that one of the issues around fracking has been regulation and coming up with ways to regulate some of those issues that I mentioned, as well as areas like methane release. But
Sure.
this ultimately question, can we come up with a scenario where we actually control the environment enough to make this economically viable? And I think you can. And clearly, companies are going to resist higher degrees of regulation. But at the end of the day, it's got to be done responsibly. And that's something that we look at very closely. We do believe natural gas is a viable, cleaner alternative, but we do concur that it has to come out of the ground in an environmentally sustainable manner.
Yeah, absolutely. Yeah, and it's interesting because the technology is always well ahead of the regulators. The regulators always seem to be behind on it.
Right, catch up.
Right, absolutely. So on another issue, here's one for you. What's your take on when you believe the U.S. will actually be off coal power?
That's an interesting question, but I think again
2030,
it comes
2030, 2035.
I think that's a fair guess. It's your guess is as good as mine at this point, but I think we're making progress in the right direction. 5-7 years ago, coal was comprising 45% roughly of the kilowatt hours of electricity we're generating in the United States. Today we're down towards 20% and moving below that. Again, this comes back to the response of companies, right? When we look at, the cost of producing a kilowatt hour of electricity from coal on a new build basis, you're looking at north of 10 roughly $100 per kilowatt hour of electricity. Does it make sense to continue to build, when you've got incumbent older plants that are roughly in, $40, $50, 50, 60, that level makes sense to continue to operate them. So we've seen all these plants that were probably scheduled for retirement, at 40, 50 years. The average age of a plant in the United States is more than 40 years. So they're extending the life in a lot of cases of these, but you're not building new plants. To comply with new regulations, you're somewhere in the range of $60 to $110, per kilowatt hour of electricity. So it comes down to do the economics make sense? And that's where you're seeing utilities make the decision to retire plants and go with cheaper forms of electricity. So if I look at, coming back to that Lazard study, if I look at utility scale unsubsidized crystalline solar at the utility scale, you're looking at $46 to $53 roughly per kilowatt hour. So, it makes economic sense to move in that direction, versus new coal targeted at $96 to $231. So it just makes a lot of sense economically to move in that direction. And that's what I think the companies, it doesn't matter if you're a car company, a motorcycle company, or a company that makes air conditioning units. Ultimately, you have to make the right decisions based upon the regulatory environment that's out there.
Yeah, absolutely. No, it's definitely on its way out as far as a source for energy. I mean, obviously it's met coal is needed for other things in other industries, but certainly the power side's on its way out. So going forward, do you see with renewables, such as solar and wind, at this point in the game, are they able to stand by themselves if there wasn't any subsidies, any grants and funding from various agencies and private outfits? Do you see that renewables and solar at this point where they are in their life cycle that they can stand on their own?
Yeah, so I think some of the success from companies out there is testament to this. But if I look at some of the rooftop solar companies in the United States, like Sunrun and Vivint Solar, they're providing electricity to homeowners at a price that is at least a 20% discount to what that homeowner would buy. They guarantee this, by the way, to what the homeowner would buy electricity from the grid. So they're gradually opening up in specific markets where it makes economic sense based on the insulation and the system cost. But the system cost has come down and continues to come down, and we believe it'll come down further in time. But ultimately, what you need to get is the price to the point where it makes sense versus the incumbent. And on a utility scale basis, as I mentioned to you, you're roughly at about $50 a megawatt hour today on utility scale unsubsidized, and that probably implies a system price in the range of 75 cents to $1 per watt. And that comes down significantly. We've seen the price of solar drop roughly 80% over the past 5 years. In the case of wind, it's roughly 50% over the past 5 years. But the key here is really driving market adoption and opening up new markets as that cost of electricity comes down. If I look at any market globally, realistically, you don't have any chance of competing in the market if you're a multiple of, for instance, of what the incumbent cost of electricity is. So, but then you've got other markets where, in India and Africa, for instance, that are starting to open up because the cost of a panel has come down so significantly. And, I heard an interesting analogy not long ago that talked about in India how a family's decision on a solar cell for their home to power their light was and charge their cell phone was really dependent upon either a solar cell or a goat. And it was roughly the same price, but ultimately the upside from having the solar cell was taking they burn a fuel within their homes for light. I forget what it's called right now, but it's on the tip of my tongue. But ultimately, it's not a safe situation. There's inhalation of fumes, et cetera, and so you're providing electricity or light within the home, and then you're also providing electricity in terms of the ability to charge cell phones. Cell phones tend to be the dominant technology. They don't have phone lines there, and so in the case of these villages, they walk 5 miles a day to charge their cell phones, for instance. So, it provides the opportunity to put electricity into the home. So, there are offsetting opportunities, but in time, ultimately, what my view is that the cost ultimately drives market acceptance, no matter what market you're in.
Right. Are you, in general, are you of a view that going forward, at least over the next couple decades, you see that wind, solar, natural gas, nuclear, there's a certain energy mix that's gonna be put in place, not only in the United States and also in other countries? Do you kind of see that some of these sources all kind of play a role at this current state in the technology advancement?
I'm not sure exactly what you mean. Can you explain that a bit?
Give me an example of an energy mix that you see in the United States over the next 10 to 15 years. I mean, what sources do you see playing the dominant roles?
Oh, I see. Okay. So, first of all, I would tell you, obviously, nuclear has been phased out. One of the biggest problems around nuclear has been cost overruns and the time to deploy the technology. One of the biggest advantages for solar and wind is really I could deploy multiple megawatts of electricity in less than 6 months period of time. So clearly there's a development opportunity or development advantage of renewables as compared to coal, nuclear, and in some cases even natural gas. So I think there's an opportunity in terms of deploying technology very fast, and on top of that, it's distributed technology in some cases. So it might be rooftop that is actually used within the actual building. So I think that there, a lot of these things that play into what renewables are versus what the incumbent technologies are. There's an evolution that's occurring, and my view is that with declining solar and wind costs, to the point of absolute economic viability without incentives, I think you're going to see a lot more. I think that it's not at all unreasonable to assume more than 50% renewable penetration in 15, 20 years. And I think obviously the writing's on the wall for coal as far as emissions go. I just don't see it being economically viable in terms of the cost nor the emissions profile. And coming back to nuclear, I think it faces a lot of the same issues, in terms of hazardous waste, in terms of the cost, in terms of the time to deploy. I think you'll see those technologies drop significantly, maybe in the range of 20 to 25% combined, and then the remainder made up primarily of natural gas.
Right. And you're speaking specifically to the U.S. So what's on another issue? Talking, just kind of switching gears, getting back over to nuclear for a moment. What's your view on the news that Bill Gates, through TerraPower, the Department of Energy, Rolls-Royce, NuScale, and other names are aggressively getting into small modular reactors? What's your thought on that?
I think ultimately it comes down to the cost viability again. The challenge with nuclear is again the cost to develop, the time to develop, and I think that in my history of working in this, say in the past 15, 20 years, I've heard of small nuclear being discussed many times, but the reality is you haven't seen the U.S. introduce a new nuclear facility since I think 1979. My memory is correct. The two that are being built right now, one by Scana and one by Southern Company. Scana has been basically put on hold indefinitely, canceled due to cost overruns and time, and Southern Company has already more than doubled the budget and the time frame. When you look at the other example out there is Finland has had a project that is just coming to completion now that was supposed to take 4 years, and it's taken 14 years to build at triple the cost that they expected. So, it's definitely unproven. We can talk about things like fuel cells. I've been covering fuel cells for many years, and there's been a lot of promise in terms of the cost. But at the end of the day, we have to think about what the cost per kilowatt hour of electricity is, and whether there's a market for it. So,
right.
if I can do solar, if I can do wind, how does that compare to nuclear? And I'm, it depends on what the timeline is in terms of how long it takes to get one of these new facilities up and running, the micro nuclear. But I think that, everything is an open book until we start to really look at what the market opportunity is. And I think it's important to listen not only to management teams, but also to people who understand the technology, and we try and do both.
Right, absolutely. And we follow, as we follow the nuclear energy side a little bit. We've done quite a bit of research over the last 2 years on it, and there's these things that are kind of popping up, whether it's states introducing stuff to help subsidize some of these plants because of their base load capabilities. Go to France. France, was talking about we're gonna be off nuclear more or less by 2025, and then a week ago the president there said that we're going to bump that now to 2035 because we can't do it. And then you have a Germany who says, oh, we're going to shut down our nuclear plants and we're just going to buy it from France, even though they didn't mention that part. And then recently there has been some protests in Germany about power bills and so forth, and why these plants have been sitting idle. And then, as you know too, Japan is slowly restarting. And Japan's got issues because Japan's an island nation. They're limited on space. They're limited on a lot of things, and so they have these plants that they've slowly restarted. I believe there's 9 operating now. And then, of course, you have China and India that are doing a build out on the traditional plant side. But what caught me that was interesting about these SMRs and the backing, and me being originally from Oregon, I kind of follow NuScale because it kind of came out of Oregon State University, is that these new small modular reactors, SMRs, can more or less be manufactured in a warehouse and delivered by transit, highway transit.
Modular. Yeah.
Yeah, right. So it's very interesting to think of what economies of scale could come from that. I'm speculating, but it is interesting. Names like Rolls-Royce getting into a Department of Energy funding various programs to do research. It does sound interesting. Of course, I think we're at least 5 to 6 years out before we even have one of these test systems. I think Rolls-Royce is trying to do more or less the same in the UK, but it is interesting to see kind of where that's going.
Well, yeah, and I think that a lot of companies, certainly with the Tesla example I gave you earlier, companies have to look at evolution, right? If companies don't change, do they become irrelevant in time? And I think it's important that any management team has an active R&D program, and it's something that we look at when we evaluate companies. How much do you spend on R&D? But what do you work on the R&D side? What keeps you up at night in terms of evolving technology? And ultimately, we could end up seeing it someday. Electric airplanes, and is a company like Boeing putting money into electrification of airplanes? And obviously lightweighting comes into play and a lot of other factors. But I think that I think it's certainly viable, and it's something that has to be reviewed. As I mentioned coal fusion earlier, and but then it comes down to, in time, fuel cell energy, for instance, has been around, I believe, since 1967, and they still really don't have what I would call an economically viable commercial product on the market. And when I look at that, I'm kind of comparing to gas turbines, for instance, that can provide baseload power as well. But I'm not saying that the price or their cost hasn't come down over a period of time, but really, what we have to look at when we look at all of this is really that electron as a commodity. And do we care? Do we care, or does it make a difference how it's generated? And if I start throwing carbon pricing in, it obviously is a benefit to renewables because you've got very low emissions, if any emissions, and that has to be factored into the price and the price of that energy. And so, one of the things I learned early on when looking at energy markets is really you have to look at LCOE. If you could get one technology that's highly, much higher cost, but the cost inputs to generate electricity, or initial cost, and then the cost inputs to generate the electricity are much lower. And it really comes down to what that cost is to create an electron, because one electron is pretty much equal to another electron. It's just, how do we make it?
Sure, absolutely. And how do we get it in the most carbon-free basis as we can to help with the fight against climate change and so forth. And so I have kind of the view that certainly in the United States, being a old nuclear country, being second to only the UK in the deployment of commercial reactors, back some 63 years ago. I do think that if this SMR technology does take off, and one of the side factors to those SMRs is what's interesting is their water treatment capabilities, and aside from their safety capabilities that these conventional reactors don't have. And so I kind of see in the United States that the conventional reactors will eventually die off, and if SMR technology does get adopted, because they have some pretty impressive benefits that are coming out from these developers. It will be interesting to see if the United States starts to adopt these smaller, 50 megawatt plants that are much smaller and so forth. So it'll be interesting to see how that plays out. Let me ask you this. Oh, sure.
Sorry. Well, and just the final point, I would just say that you're seeing a lot of shutdowns on the nuclear side too, more driven by economics and life, really, right? So does it make sense to inject another 100 million, 400 million, whatever the number is, into a 50, 60-year-old plant to extend its life? And that's really the balancing equation for utility. They've got ratepayers who they have to answer to, and to consumer advocates. Ultimately, does it make sense to do that, or does it make sense to go on to less polluting or lower cost electricity form of electricity.
Sure, absolutely. In the U.S., we all know, at least I'm speculating, I don't have the numbers in front of me, but the U.S. is probably one of the highest cost jurisdictions. I mean, obviously, it's cheaper, much cheaper in France. France nuclear program is much cheaper than what the U.S. has going, and of course, in places like China and Saudi Arabia, India, it's all a matter of jurisdiction. What is the total cost? And so it's interesting to consider those approaches too, and just with China's sheer population, it's interesting to see with the government's push towards obviously nuclear power is obvious there, and then obviously too the electric car revolution in China. The government's certainly pushing that as well, and they have some significant pollution issues, as you know.
Well, yeah, and pollution is certainly a big issue in China. But one thing that can't be overlooked is that when solar was really kind of getting its feet in the early 2000s to mid 2000s, pretty much all of the global manufacturing capacity was in Scandinavia and Germany, and Germany was really the leading company in terms of incentives for solar power. And what it came down to in time is you had developers starting to see production coming out of China that cost a fraction of what the European manufacturers were making it for. So in the case where you had roughly 90% of production in Europe, now you've got 90% of production in China. And because ultimately it's the lowest cost form of solar power that they found, like in terms of manufacturing. But back in those days, we were seeing companies on the solar side that were generating 50-60% gross margins back in that mid 2000 kind of time frame. Now you've got Chinese companies that are generating gross margins in the 10 to 14% range. And again, it comes back to the discussion of it's a race to the bottom. Ultimately you're making a panel and focused on creating the lowest cost per kilowatt hour, which opens up new markets globally. But I personally continue. There's no way that I believe there's no way that you're going to see the price of solar power go up. It really is. It's never been a situation of driven by cyclical markets. This secular story that developed in the 2000 kind of time frame of the opportunity globally for solar has certainly evolved into more of a cyclical. And I believe that anything in time that's secular eventually becomes cyclical. It doesn't matter if it's LED bulbs, cars, or solar panels. But a cycle is typically created by an overbuild of supply, and that's really what you had happen in China. So if we look at the Chinese market today, it accounts for more than half of global solar sales. But a lot of that's got to do with incentives that have been driven by the Chinese government and a focus, coming back to what you said initially, of creating a cleaner environment in China.
Right, and for an investment fund like Greentech, and for investors in general, it's more difficult to find these companies where back in the day you might have a 50% margin. That's pretty attractive, but now it's getting even more difficult, on some of the solar parts and pieces that happen that make up the panels. It's harder to find those investments that provide a good margin. So it's interesting to see how that plays out as well.
Yeah, and I think if I look at an area like solar, for instance, I can invest in the whole value chain, right? And one of the things as an investor that I tend to look at is really where do I want to be invested in that value chain? Certain parts of that value chain generate higher rents at certain periods of time. So we're typically focused, and solar is a decent example, just because you end up looking at the constraints and excesses in any supply chain. And if I look at solar specifically, where are the constraints and where are the excesses? And back in the early days, it was polysilicon. Polysilicon shot up from $18-20 a kilogram to $500 a kilogram because really there wasn't a global supply of solar grade silicon. It was really targeted towards the tech industry. And now that we've had a build out of the supply base, the price of silicon's actually dropped down to roughly $9-10 a kilogram.
Sure.
So, silicon's not a great area these days to be invested in. We actually, coming back to some of the discussion that we've just had, our area of focus more lately in terms of higher returns has been the developers. The developers are able to, with declining costs of systems, you're seeing a lot better returns on the development side, and that tends to be where we focus our investment dollars these days.
So right now, as you know, aside from run of the river, the sun, and wind, all this technology that we're talking about, generally is coming out of the ground in some form. And so, from a viewpoint of the parts and pieces, the components that go into a wind turbine, the stuff that goes into a solar panel, the stuff that goes into nuclear fuel, all of these things are coming out of the ground. So does Greentech look at that end, kind of the picks and shovels, if you will, of the industries?
We do, and it's part of that whole value chain equation that I just mentioned to you earlier. So, in the case of silicon, that's there's silicates that are mined, for instance, or in the case of batteries, it's lithium. We tend to not focus a lot of our investing emphasis around that area as more lately, because when we look at the mining operations of a lot of these industries, it tends to be less environmentally friendly. Then the challenge becomes, how do I balance the fact that you're investing in solar panels or lithium batteries versus the initial mining component of it? Really coming back to almost what you said about fracking a few minutes ago. Really, it's does it end up being that much different? So, I would tell you that we're cognizant of some of the social issues. A lot of it, for instance, is in countries that may be less focused on the social side of things. But we are very aware of some of those issues. In time, I think all of this ends up becoming much more environmentally focused, and we monitor that. We look for opportunities to invest where there's a strong ESG angle to whatever company or whatever technology we're looking at. An example might be Johnson Matthey is talking about coming out with a form of lithium battery that uses no cobalt. Cobalt has inherently a lot of issues in terms of African mining and more social issues, obviously. But that's been one of the controversies associated with lithium batteries.
Right. Yeah, it's interesting because for us, all of us, we try to, as humans, we consume things and we enjoy modern life, in which whether it's our iPhone that we plug in at night or products that we use, electric vehicles, all of this stuff, whether you fool the investors or fool the people or not, all this crap's coming out of the ground, and in most cases. And so you have these different things, and so ultimately, you do look at these industries, you look at the supply demand fundamentals, whether you're talking about uranium today, which is a hot topic, or vanadium for different types of battery technologies, or nickel or cobalt.
Or oil, so now, oil or natural gas, right?
Sure. So what's your thoughts on the battery side? Tell us, what are your thoughts on nickel and vanadium making up a larger part in this new battery technology?
Well, we think it's good, but ultimately, what we come back to every time, you mentioned a lot of those good and bad things, is ultimately, is there a better way to do things, right? That's sort of what I kind of term as creative destruction. And, is there a better way to have a car operate? And or is there a better way to generate electricity? And, I clearly there's a lot of corporate interests that are built up that are not that fond of the rise of the electric vehicle, for instance, or, things that use energy more efficiently. But, when I look at one of the big disruptors that's sort of overlooked generally is data. Everything today is being measured. It doesn't matter whether it's your electricity system in your building or the amount of water consumed by, plumbing, et cetera. Like everything is being measured these days, and it's driven by data. Data drives the value of data. I think is highly underestimated, and data is going to drive social change. I think it's going to drive much higher efficiency across every industry. And
Right.
be it and ultimately, if I can look at a battery, for instance, and are there characteristics that are driven by data, for instance, that would suggest more use of vanadium or nickel or less use of cobalt, or can we come up with a better way of doing things? And I think that's ultimately what we look for. We look to the disruptors, right? We look for the companies that are making a difference, and it might be small nuclear reactors in one case, or it might be electric cars in another case, or solar panels. But ultimately, I think one of the things is, as far as what we do, is that disruption plays a huge part in sustainability. And can I come up with a better way of doing things? Can I come up with a cleaner way of fracking, for instance? And I think it's possible. I think it's absolutely possible. It's incumbent upon us to find the companies that can do that.
Right, absolutely. So, hey, there's a few more things I want to get to before we wrap up the call.
Sure.
Switching gears yet again, David, how does Greentech approach the fact that the broad market bull cycle is getting tired? How are you positioning the firm for an eventual decline?
Well, that's an interesting question, and ultimately it comes down in our minds to cyclical versus secular. And when I look at a lot of these emerging technologies, if that's what you want to call them, or disruptors, we look really at a company that's adopting sustainability as a company that is likely gaining market share. It's growing faster than its peers. It's expanding margins because it's reducing waste of, say, things like energy and water in its process. It's acting more efficient, and ultimately it leads to a lower cost of capital. So, in the end, we see this as beneficial for companies, but we want to own the companies that are going to grow for a long period of time. And, and I think it's a fair thing for you to come back to me and say, well, you just said a minute ago that everything secular eventually becomes cyclical. And I do believe that's the case. But I do think that it's incumbent upon us to find the secular growth companies today. So that might be an electric drivetrain company. Typically an auto cycle is 5 to 7 years. So, in the case of automotive, shifting from gasoline to electric, for instance, we think that this is going to be a very long period of time. But we also think those companies that are driving change in the automotive industry, companies like a Borg Warner or a Delphi that are making alternative powertrains, they've got a long growth curve ahead of them because they have to be designed into vehicles. And we're also seeing the decline of diesel, so the market share shift as far as automotive goes. But we do think that there are companies that are going to grow faster than the cycle as a result of having higher content or providing disruptive products or services that come at a cost to the incumbents that are maybe slower to switch, or companies that don't adopt sustainability as fast as others. So, to answer your question, while we do see this bull cycle, or expansionary cycle as very long in the tooth, having started in 2009, we're also seeing the opportunity to find those companies that can actually grow regardless of the economic climate. Companies that that are achievers, companies that are disrupting and providing a better way of doing things that allows them to grow their content faster than those companies that are not doing so.
Okay, no, that's interesting, and it'll be interesting to see how some of these react when liquidity hits on the downside, and as sometimes some of these equities, they all get waxed no matter where they are.
Yeah, I think you have to look at everything in terms of it's a relative game to an extent, right?
Sure. Right.
Ultimately, if the market's down 40% as it was in the 2008 time frame, can you outperform that market? Can you find companies that are well positioned to grow? And if I look at a company, for instance, on the solar arena, for instance, if you saw a market decline, can this company grow their earnings regardless of the economic climate? So, that's the type of company that we're looking for. We're looking for a company that can continue to grow or outperform regardless of market conditions.
Right. No, that's interesting. And if you can have that kind of robust setup, that's a good place to be. So coming back to Tesla. So as you know, and I'll certainly give some credit there as well, that the leadership at Tesla has been visionary. It has really advanced the EV revolution, or the electric vehicle stuff that's going on, and battery technology. And so it's quite impressive where they've gotten with going forward. And with that, we've the taxpayers, all of it, you and us, all of us have indirectly supported the advancement there and so forth. And Tesla remains yet to become in my opinion, is to become an operating automotive manufacturer versus a technology leader is the big question mark. And can the company with their current balance sheet continue to plow ahead, or how do you see the big elephants in the room, the Mercedes, the Toyotas, the Hondas, those types of companies with their balance sheets and their long time operational expertise? How do you see them coming into the EV market? And do you see Tesla continuing to lead, or do you see Tesla kind of passing the keys off to somebody else going forward over the next 5 to 10 years?
Well, you bring up a very pertinent issue. What I would say is Tesla's, at least now, as of the last quarter, and what Elon Musk is saying for this quarter, has turned the corner and become cash flow positive. Now, the Model 3 clearly was a very difficult exercise to commercial viability, and now the latest numbers I've heard is that they're at 1,000 vehicles a day in terms of production. Now, what's important is market share, and can you generate volumes? The auto industry is highly fixed cost industry. It's very dependent upon volume, and you brought up an interesting point that we've talked about before. That's very important. Is this a tech company or is this a manufacturing company? So a lot of the disillusionment that happened in what I would call alternative energy, clean tech on the VC side in probably the 90s and 2000s was that this was tech and that these VCs would see a return similar to what they've seen, by investing in the Facebooks, the Googles, the Ubers, et cetera. The fact is that an auto company is highly capital intensive. You're building massive factories. In the case of Tesla's Fremont facility, you're talking about 500,000 units per year of production. That's a lot of cars, and clearly a lot of investment in people, a lot of investment in facility, et cetera. And so can they get to the point where they're economically viable? They've gotten to that point now. What's the response of the competitor? Market share. So the response, ultimately, coming back to what I'd said initially, is do you become irrelevant in the marketplace? And so let's take this all back to economics. And I think that the one thing about electric vehicles is certainly that they're low emission, they're very environmentally friendly. But again, the only way you get mass market acceptance is green has to be green. The economics have to be more favorable to the consumer. I mentioned the LED bulb, we've talked about solar, but really when we look at automobiles, what does it cost me to fill up my car today? In the case of an SUV, maybe it's $75 to $100 to buy gasoline. If I have an electric vehicle, what does it cost me to plug in my car at night and have anywhere from 200 to 400 miles of range the next day? The numbers I've been reading are in the range of $2 to $5, depending on the market that you're in. So if I can get that kind of range, which is pretty much the same as my gasoline vehicle, for a fraction of the price, it ultimately comes back to what is the initial cost of the vehicle. So clearly we're aware that of the price of Tesla vehicles. The Model 3, we had heard about $35,000. The reality is it's been much higher because of mix in terms of options, range, et cetera. The Model S, I believe it's north of 70,000. The Model X is north of, I believe, 80 or 90,000. But is that a price that's attractive to the consumer if I factor in the cost of operating the vehicle? And when I look at the primary operating cost being the cost of electricity and the fact that the service costs on an electric vehicle are much lower than a gasoline vehicle. By the way, dealers hate electric vehicles because there's really no service component to them. But that said, can I buy a car at parity or less to a gasoline vehicle? And when I look at the cars that they're talking about coming out with now, really actually pose an interesting conundrum for Tesla because what I've heard about the Mercedes, for instance, the Mercedes EQC, is that it's going to be priced in the $70,000 range, which is much less than the Model X. It's certainly probably more. It's more of a market price for a small luxury SUV. In the situation with Audi's e-tron, very similar. I'm hearing $70,000. In the case of the Porsche Taycan, which is really a sports car, they're saying probably somewhere in the range of $70,000 to $90,000, which is it's actually cheaper than a 911, but it's respectable as far as the price of a sports car goes. And by the way, Elon Musk's sports car, he's talking about $200,000 to $250,000. So do you get to the point where the consumer can actually buy a car, an electric vehicle, for the same price or less than a gasoline-powered vehicle and not have the marginal costs of service and gasoline? Volkswagen is talking about setting up a facility here in the United States to manufacture electric cars that we price in the range of $20,000 to $30,000. Clearly at that point, if you can do an electric car for $20,000 to $30,000 and have all the characteristics of low cost of operating the vehicle, I think it's a very difficult proposition for Tesla's obviously going to have to come down in price to maintain market share or come out with different products, which they're talking about doing as well. So I guess at the end of the day, it really comes down to what is the economic scenario. And your point about balance sheet is very valid. One question is Daimler making money at $70,000 on that new electric vehicle? Is Audi making money? An interesting point that I mentioned, the Porsche Taycan, they announced yesterday that they're actually going to up their production targets for that the run of Taycan that's coming out based on the order flow that they're getting already, and they're adding a second vehicle type called the Gran Turismo, I believe. But it really comes down to having an array of vehicles. Bloomberg says by 2022 we're going to see 300 different models globally. Tesla's had the lead. I'm absolutely no question about it. Is it 5 years? Is it 10 years? But they've definitely got the lead. He's broken the market open. He's caused everybody to blink, and he's made it happen probably 5 to 10 years ahead of when it would have otherwise happened.
Right, absolutely. No, it's interesting to see where it'll play out and with the economics of these businesses. When you factor in the consumer credit cycle as part of this, and the fact that specifically more in the U.S., the GMs and so forth tend to offload these vehicles. We don't care. We don't care if you're someone who's going to repay the loan or not. I mean, they are really pushing these out, and so it'll be interesting to see how the credit cycle plays into these manufacturers who are just rolling these cars out.
Well, yeah, and they've got the balance sheet to say, hey, look, we can't afford to be obsolete. You've obviously got 5 to 10 years of lead on us, and are we selling these things at a profit? Nobody will know. They never break out the. These are a fraction of their total production. There were rumors that Toyota never made money on the Prius. But I think now automobile manufacturers have become aware that people will buy electric cars if they're good-looking cars.
Sure.
And that's. I'm not trying to offend anybody who owns a Prius, but it's never been the best looking car on the road. Now you've got Teslas, you've got other cars that are coming out that are very attractive, very consumer appealing cars that ultimately can win significant market share over time. But, a company like a Daimler can afford to lose money on this realizing that they have to price it in line with the market for the incumbent vehicles. And at that price, it will be interesting to see how the consumer reacts. Is what I will be interested over the next 3 to 5 years.
Right. Yeah, and these automobile manufacturers are pretty capital intensive, as you said, and unless there's another type of 2008, 2007 type event where you can scoop up these auto manufacturers for pennies on the dollars, I think I'll stay clear of these folks for now.
Well, but the interesting thing there too is that I mentioned how it's a more simplistic design for an electric vehicle. You've got several upstarts. There's a company called Byton, for instance, a company called Neo, there's Faraday, there's Lucid. There was a company that exhibited a pickup truck last week at the LA Auto Show that was extremely attractive vehicle that they're saying will have 400 to 500 miles of range. So, is there more opportunity for more disruption? Is there opportunity for more upstart companies to come in with the simplicity of an electric drivetrain as compared to previously, where you didn't see many successful new companies, disruptive companies come along and upset the auto industry?
Right. So give us a dollar range of the size of deals that Greentech does, and also give us the time horizon that you guys look for at your firm for these investments.
Well, so as I mentioned, there's two sides to the business. One is the asset management side, and one is the investment banking side. On the banking side, I'd be hesitant to give you a direct number, but certainly, we're involved in M&A. We're involved in financings related to public and private companies. On the asset management side, we tend to look at companies in excess of a $200 million market cap up to many billions of dollars. But as we sit today on the asset management side, we're just under $100 million, as I mentioned, and looking to raise more capital as time allows. And
how about the time frame for your guys' investments?
Typically, we look to own something for at least a year. So, we tend to be what we call value with a catalyst investment style. So we like to buy value, but we also realize that value can be a trap at points. So we need a catalyst that's going to unlock that value. So, that catalyst could play out in 6 months. It could play out in 12 months. It could play out in 2 years. But, ultimately, we want to buy things with significant amount of upside in relation to the risk or to the downside. So, ideally, we've got some names in the portfolio that have been around since inception. We're hitting our 4th year now in terms of operations, but we could easily own companies in excess of 3 years.
Okay, very well. So, David, how can potential investors reach out to you in Greentech?
You can either contact myself, David Smith, or Rob Schultz, who's Chief Operating Officer of the firm. And my email is david@gcainvest.com. And Robert's is also available on the website, but it's robertschultz@greentechcapital.com.
Okay, and is there any requirements online for just stuff about accredited investors and your guys' minimum investments and so forth online, or
Yeah.
do they need to contact you directly about that?
No, that should be all available, and any questions that can't be answered, we'd certainly be able to answer them in a discussion.
Okay. Well, David, we appreciate you taking the time and coming on today, and it was a great, extensive discussion, and we look forward to having you back again.
We'd love to chat. Thanks.